Do you know that $1 invested in U.S. stocks in the 1800s is worth $3.6 million today? That's an astonishing sum, but who has 200+ years to wait for their money to grow? Certainly not us mere mortals. However, what if I told you there's a way to make even more money in a much shorter time frame? Brace yourself as we unveil the secrets of the Schwab U.S. Dividend Equity ETF, SCHD, and how you can potentially turn $100,000 into a staggering $6 million without waiting centuries. Have you ever considered investing in dividend-focused ETFs like SCHD? What factors would motivate you to explore such an investment strategy? Before we dive in, I want to remind you to hit that like button and subscribe if you haven't already. It really helps my channel grow, and I appreciate your support. Understanding exchange-traded funds, ETFs. ETFs track the performance of a basket of assets, such as stocks, bonds, or commodities. Dividend ETFs, in particular, track a basket of dividend-paying assets, making it easier for investors to gain diversified exposure without picking individual stocks. The Schwab U.S. Dividend Equity ETF, SCHD, is a passively managed ETF designed to offer broad exposure to the large-cap value segment of the U.S. equity market. With assets totaling over $55 billion, SCHD ranks as one of the largest ETFs in this segment and boasts a low expense ratio of only 0.06%. What do you think are the main advantages and disadvantages of investing in ETFs compared to individual stocks or other investment vehicles? SCHD's portfolio composition. Stringent selection criteria. SCHD has 103 holdings, with its top 10 holdings making up 41.43% of the portfolio. The ETF employs a rigorous selection process, considering factors such as a minimum 3-month average daily trading volume of $2 million, dividend yield, 5-year dividend growth rate, company financial health, and return on equity. This ensures that the companies included are financially robust and have a solid track record of dividend payouts. A portfolio of household names. When you invest in SCHD, you're putting your money into over 100 large American companies that pay dividends and are considered both valuable and high quality. Some of these well-known names include Texas Instruments, TXN, Coca-Cola, KO, Pfizer, PFE, Chevron, CVX, Verizon, VZ, PepsiCo, PEP, and Cisco Systems, CSCO. Giants in their respective industries, known for their reliability and potential to pay good dividends. Do you prioritize investing in well-established, dividend-paying companies? Or do you prefer to take on more risk with growth stocks? What factors influence your investment strategy? 7 facts that make SCHD stand out. Fact number 1. Low-cost investing. One of SCHD's standout features is its incredibly low expense ratio of 0.06%. For a $10,000 investment, you would only pay $6 annually in fees, making it a cost-effective investment option. Fact number 2. Robust index methodology. SCHD's unique and robust index methodology ensures that you're investing in companies with consistent dividend payments for at least 10 years, a float-adjusted market cap of $500 million or more, and sufficient liquidity. Fact number 3. Emphasis on company quality. Once companies pass the initial screening, SCHD ranks them based on their indicated annual dividend (IAD) yield, cash-to-debt ratio, profitability, income generated from dividends, and 5-year dividend growth rate. This comprehensive evaluation ensures a blend of company stability, profitability, and dedication to increasing dividends. How important is a fund's index methodology and screening process in your evaluation of potential investments? Do you believe SCHD's approach strikes the right balance between risk and reward? Fact number 4. Recession and inflation resistance. Recession-resistant holdings. SCHD's portfolio comprises companies that tend to perform well even during economic downturns, such as Coca-Cola, KO, Pfizer, PFE, and PepsiCo, PEP. These companies offer essential products and services that remain in demand regardless of economic conditions, making them less susceptible to recessions. Inflation-resistant holdings. Many of SCHD's holdings, including healthcare companies like Amgen, AMGN, and Pfizer, PFE, as well as financial institutions, have the ability to raise prices in response to inflationary pressures. This pricing power helps maintain profitability and dividend payments during periods of high inflation. How important is it for you to invest in companies or funds that can weather economic storms and maintain their dividend payments? Do you prioritize stability over potential growth during uncertain times? Fact number 5. Virtually risk-free in the long term. The risk of all 103 companies in SCHD's portfolio going bankrupt and their stocks plummeting to zero is close to zero. SCHD's diversified portfolio, comprising 103 large, dividend-paying companies across various sectors, significantly reduces the impact of any single company's performance. Even in the event of a catastrophic scenario like nuclear war, which has a 1% chance of taking the S&P 500 to zero according to Goldman Sachs, SCHD's diversification provides a buffer against complete loss. How do you define and assess risk in your investment portfolio? Do you consider diversification a crucial factor in mitigating risk, or do you prioritize other strategies? Fact number 6. Safe and growing dividends. Dividend growth track record. SCHD has been delivering increasing dividend payments to its investors every year since its inception. The ETF follows a strategy that emphasizes safe, high-quality investments with a history of increasing dividends for more than 10 years, indicating a commitment to long-term dividend growth. Impressive dividend performance. In the last year, SCHD has provided a dividend of $2.67 per share, with a return of 3.48%. Over the past 10 years, the compounded dividend growth rate is at 10.87% annually, demonstrating the fund's dedication to providing a growing income stream to its investors. How important are dividend payments and their growth potential in your investment considerations? Do you prefer to reinvest dividends or use them as a source of passive income? Fact number 7. Tax advantages of dividends. Favorable tax treatment. When you earn income from bonds, it is treated as regular income and taxed accordingly. However, dividends from SCHD are considered long-term investment income and are typically taxed at a lower rate of around 15% for most investors. This lower tax rate can significantly impact your overall returns compared to other investment vehicles. Tax-advantaged accounts. You can legally avoid paying any taxes on your SCHD investments by utilizing tax-advantaged accounts like 401k plans or Roth IRAs. This tax-efficient approach allows your investments to compound more rapidly. The power of compounding with SCHD. Now that we've explored the key facts that make SCHD a compelling investment option, let's delve into the real magic, the power of compounding over time. Let's consider the hypothetical case of Tom, who decides to invest $100,000 in SCHD and reinvests the dividends. Based on SCHD's historical performance, we'll assume a 3.48% dividend yield and a compound annual growth rate of 10.87% over the past 10 years. Year 1. In the first year, Tom's $100,000 investment grows to $103,480, and he receives $3,480 in dividends. Year 10. After a decade, Tom's investment has quadrupled to $421,421 with dividends reinvested, and he's receiving $14,665 in annual dividends, more than enough to cover his auto loan, gas, and Netflix subscription. Year 20. After 20 years, Tom's investment has grown to a staggering $985,766, and he's earning $34,304 in annual dividends. That's $2,858 every month. Year 30. If Tom leaves his money in SCHD for 30 years, his investment would swell to an incredible $2.49 million, and he'd receive a whopping $7,218 in dividends every month. Of his total gains, $2.21 million would come from the growth of SCHD, while $279,000 would be from the reinvested dividends themselves. Seeing the power of compounding in action, how does this influence your perspective on long-term investing? Are you willing to adopt a patient, disciplined approach to allow your investments to grow over decades? SCHD's combination of a robust index methodology, recession and inflation resistance, virtually risk-free long-term performance, safe and growing dividends, and tax advantages make it a compelling investment option. By embracing the power of compounding and adopting a long-term mindset, you too can potentially turn a modest investment into a multi-million-dollar empire without waiting centuries. As we conclude our exploration of SCHD, reflect on your investment goals and risk tolerance. Are you ready to embark on a journey towards financial freedom by harnessing the power of dividends and compounding? The path may be long, but the potential rewards are truly remarkable. You may also wish to check out my other video on the 10 buy and hold forever dividend stocks in the link above and in the description down below. Have you thought of how much money you need to live off dividends forever? Comment below. If you enjoyed this video, do like and share this video so that more people will learn about how to live off dividends forever. Check out this playlist of my top 10 videos for creating wealth, and I'll see you in the next video. Take care.